Mark Mahaney. So a little bit of love for Meta today. It's up 3% after a pretty rough stretch here. It doesn't sound like the FCC can really move to ban TikTok, though, Mark. What do you think?
No, I don't think so. I think if you're an investor, you have to assume that's a very low probability event. I think the only interesting angle here is if there's probably the issue that has the one issue that has more political consensus other than lashing out at big tech is lashing out at China. So, maybe something that's in the U.S. So maybe something actually would occur. But I think the probability of that is pretty slow, but is pretty low. But anything that sort of gums up TikTok, I mean, that's been the biggest competitive risk, no doubt about it, to Facebook, to Snap, to Meta, to Snap. So anything that's bad for TikTok is positive for Meta.
But not a reason for investors to buy it necessarily on this news. Is there a reason for investors to buy either of these companies, which got shellacked again on earnings?
Yeah, I think so. Look, the user base continues to climb at Meta. Engagement continues to climb. This is a company that's a highly profitable business, 30% margins. They're aggressively investing, as is Google, in artificial intelligence, $35 billion a year in CapEx. The market is essentially treating all of that as a loss and maybe not giving them any credit for the idea that they may possibly, through all that spend, come up with better products that are better for consumers, for advertisers, for enterprises. That's my guess. These companies have generally been pretty good stewards of investment, capital allocation in the past. My guess is that they will be in the future. So I know there's a lot of things that go behind all this AI spend, but I don't think they're getting any credit for the positive return they could get on that investment. And the stock is so cheap. Yeah, I just don't think things get worse from here from Meta, but I also didn't think that a week ago. So, we'll see. But I continue to like Meta.
I was going to say, you've liked all these stocks. You've liked Meta. You really like Amazon, which right now is down 6%, about to close at the lowest since 2020. What do you think you got wrong? Because it did for a long time look like these were defensive growth companies that could hold up better, relatively better in a recession.
Well, I'm not sure they're defensive. I don't think there's anything in consumer internet that's defensive. I mean, it's cyclical. They may have some resilient factors. Cloud computing probably holds up at 20% year-over-year growth when GDP goes flat or negative. I think search advertising can still stay 5 to 10% year-over-year growth when overall advertising is going to decline next year. So there's some recession-resilient elements, but there's nothing in consumer internet that's recession-proof. Recession-resilient part of it, and there's the much heavier exposure is consumer discretionary. That's Amazon's retail business, consumer discretionary, and so is most of the advertising that goes on in the internet. So that shoe is starting to drop. The question we all have to ask ourselves is how much further is that recession shoe going to drop, and is that estimated and valued correctly in these stocks? That's a very hard call to make. I think it is, but I'm more nervous about the next 2 or 3 months. I'm more confident about the next 2 or 3 years.
So have you changed your views on all? And I know you had to adjust price targets, but have you changed your view, your positive view on any of these companies in light of what we got for earnings?
Not yet so far. And we've had a couple of positive surprises, so it hasn't all been negative. Uber gave us some positive news, not necessarily on demand, but in terms of profits. And then you have with Netflix a brand new revenue stream. So those two remains amongst my top picks. I'm more cautious near term, no question about it, on names like Google, on Facebook, and on Amazon. If you're willing to look out more than 12 months, I think these fundamentals are going to inflect back up positively, and they're still really well-run companies for the most part, particularly Amazon and Google. So yeah, I would stick with those. The more they get beaten down, the more attractive they should be, and they are to long-term investors like myself.
Yeah, you've liked Uber. Uber's up 12.3%. Having a good day off those earnings. We're going to talk about later in the show. Mark Mahaney, thank you very much. Always good to talk to you.